Pay attention, because what I'm about to walk you through is buried in institutional trading data that most retail investors will never see. And by the time the financial media catches up to this story, the opportunity to position yourself will be gone. Between September 2019 and February 2026, the Federal Reserve's standing repo facility has been accessed by more than 10 institutions in a single trading session exactly 4 times. 4 times in 7 years. September 2019, the repo market seizure that forced emergency Fed intervention. March 2020, the COVID liquidity crisis. March 2023, the regional banking collapse that took down Silicon Valley Bank and Signature Bank. And February 5th, 2026, 14 institutions in one trading session. That number is not speculation. It's documented in the Federal Reserve Bank of New York's operational data, published with a 48-hour delay, which means that by the time you're seeing this analysis, institutional trading desks have already had 3 full days to reposition. The smart money already knows. The question is whether you understand what this signal means and whether you're prepared for what follows when a $4.6 trillion overnight lending market sends the same distress signal we saw 90 days before Lehman Brothers collapsed in September 2008, 60 days before the European sovereign debt crisis went systemic in 2011, and 72 hours before Silicon Valley Bank was seized by regulators in March 2023. This is not about predicting a crash. This is about recognizing that the plumbing of the global financial system is seizing, and when the plumbing fails, the house floods. By the end of this analysis, you will understand the 3-variable framework that governs every modern liquidity crisis. The $6.8 trillion unrealized loss problem sitting on bank balance sheets that makes this different from every market dip you've seen in the last 5 years, and the 3 asymmetric positioning strategies that will determine whether your portfolio survives what's coming or becomes part of the collateral damage. Let me be very clear about this. This is not theory. This is not commentary. This is pattern recognition based on institutional behavior, publicly available Federal Reserve data, and historical parallels with exact dates and outcomes. Turn off the distractions and lock in, because the clock is already ticking. The 3-variable framework. Every liquidity crisis follows. Before we dissect what happened on February 5th at 2:47 p.m. Eastern Time, you need to understand the framework, because liquidity crises don't announce themselves with sirens and flashing lights. They announce themselves through breakdowns in the 3 variables that govern every functioning financial system. Variable 1, the availability of cash in the system. Variable 2, the velocity of that cash moving between institutions. Variable 3, the willingness of counterparties to lend to each other. When all 3 variables are functioning, Repo rates the cost for banks to borrow cash overnight, using Treasury securities as collateral track within a few basis points of the Federal Reserve's policy rate. Right now, that's 4.5%. On a normal day, a bank can borrow overnight cash at 4.5%, maybe 4.6%, maybe 4.8%. Small fluctuations. Nothing systemic. But when any one of those 3 variables breaks, the entire overnight lending market can seize in a matter of hours. And when that happens, repo rates don't drift higher. They spike. On February 5th, 2026, repo rates went from a normal range of 4.5% to 4.8% all the way to 9.2% in the afternoon trading session. That's a 104% increase in the cost of overnight funding in under 3 hours. Let me repeat that. A 104% increase in 3 hours. Not because the Federal Reserve changed policy, not because of a geopolitical shock, but because something in the overnight lending market broke. Now, here's what makes this dangerous. The repo market is not some obscure corner of finance. It is the absolute foundation of how banks, hedge funds, broker-dealers, and institutional investors manage short-term liquidity. Repurchase agreement. Here's the mechanic. A bank holds $100 million in 10-year Treasury securities on its balance sheet. It needs cash today to meet margin calls, to fund trades, to settle obligations. It goes into the repo market and sells those treasuries to another institution, typically a money market fund, or another bank, with an agreement to buy them back the next day at a slightly higher price. That price difference is the repo rate. It's an overnight interest rate on a collateralized loan backed by U.S. Treasury securities, which are supposed to be the safest, most liquid asset on the planet. So when repo rates spike to 9.2%, when 14 institutions access the Federal Reserve's emergency standing facility in a single day, the message is not ambiguous. Major financial institutions are desperate for cash. They're willing to pay any price to get it. And private market lenders either don't have the cash to lend, or they don't trust the institutions borrowing it. This is the exact same pattern we saw in September 2019 when repo rates spiked to 10% overnight, and the Federal Reserve had to inject hundreds of billions in emergency liquidity. It's the same pattern we saw in March 2020 when COVID hit and repo markets froze entirely, requiring the Fed to deploy over $1 trillion in a matter of days. And it's the same pattern we saw in March 2023 when Silicon Valley Bank collapsed and regional banks suddenly couldn't access overnight funding. The pattern repeats because the structure is the same. Liquidity crises move faster than solvency crises. By the time an institution is declared insolvent, the liquidity breakdown has already destroyed wealth across the system. Why 1931 is the blueprint. Everyone's ignoring now. Let's connect this to history. Because the framework I just described didn't originate in 2008, it originates in 1931, which is the most underreported and least understood financial crisis of the 20th century. And it's the blueprint for what we're watching unfold right now. Most investors think the Great Depression was caused by the stock market crash of 1929. Wrong. The stock market crash was the trigger, but the real destruction of wealth happened between 1931 and 1933 when the banking system collapsed due to a cascade of liquidity failures. In May 1931, Creditanstalt, Austria's largest bank, collapsed, not because its long-term assets were worthless, but because it couldn't meet short-term obligations. It had loans on the books, it had real estate, it had industrial holdings, but it couldn't convert those assets into cash fast enough to meet depositor withdrawals and interbank obligations. Liquidity death. The collapse of Creditanstalt triggered contagion across Europe within weeks. German banks faced runs. British banks faced runs. And by the end of 1931, over 2,300 banks in the United States had failed. The common thread was not insolvency, it was illiquidity. Banks stopped lending to each other because they didn't trust that the borrowing bank would be able to pay them back the next day. The overnight lending market between banks, the 1931 version of the repo market, froze. And once it froze, institutions with perfectly sound balance sheets died because they couldn't access cash. Here's the lesson. Liquidity crises don't care about fundamentals. They care about cash flow and counterparty trust. And when trust breaks, the cascade is brutal and fast. The investors who preserved wealth in 1931 were not the ones with the best stock picks or the most sophisticated portfolios. They were the ones who recognized the liquidity warning signs early, moved cash out of banks above insured limits, converted paper assets into gold, which was still legal to own at that time, and held liquidity in the safest possible vehicles. By the time the banking crisis was obvious to everyone, it was too late. The cascade had already wiped out depositors, bondholders, and equity investors across the system. Now, fast forward to September 2008. Same pattern, different mechanism. Lehman Brothers didn't collapse because its mortgage-backed securities were worthless. It collapsed because the repo market froze. Lehman was borrowing tens of billions of dollars every single day in the repo market to fund its operations. In the summer of 2008, repo lenders started pulling back. First, they demanded higher haircuts, meaning they would lend less money against the same collateral. Then, they demanded higher interest rates. Then, they stopped lending altogether. On September 15, 2008, Lehman Brothers filed for bankruptcy. Not because its assets were worth zero, but because it couldn't access the cash it needed to open for business that morning. Liquidity death, and once Lehman fell, the contagion went global in hours. Money market funds broke the buck. Commercial paper markets seized. The entire financial system came within a day of a complete shutdown. The Federal Reserve and the Treasury had to deploy trillions of dollars in emergency interventions through TARP, through the discount window, through direct repo facility operations, through outright bailouts of AIG, Citigroup, and Bank of America to stop the cascade. Here's what connects 1931 and 2008 to February 2026. Both periods were preceded by asset price inflation funded by cheap and abundant credit. Both saw leverage build across the financial system to unsustainable levels. Both experienced an initial shock that exposed the leverage, and both saw the overnight lending market freeze as the mechanism of contagion. We are now at the initial shock phase, and the trigger this time is not subprime mortgages. It's not European sovereign debt. It's the $6.8 trillion in unrealized losses sitting on U.S. bank balance sheets due to rising interest rates. And that makes this crisis structurally different and potentially more dangerous than anything we've seen since the 1930s. The $6.8 trillion unrealized lost time bomb. Let me explain the mechanics of this, because this is the quiet mechanism that makes the February 5th repo spike a systemic threat and not just a temporary dislocation. When a bank buys a treasury bond or a mortgage-backed security, it books that asset at par value on its balance sheet. If the bank buys a 10-year treasury bond yielding 2% and holds it to maturity, there's no problem. The bank collects the coupon payments, gets its principal back in 10 years, and everything is fine. But if interest rates rise, the market value of that bond falls. A 10-year treasury yielding 2% is worth significantly less in a market where new 10-year treasuries are yielding 5%. Basic bond math. Duration risk. The bank hasn't technically lost money yet because it plans to hold the bond to maturity. But if the bank needs to sell that bond to raise cash, it has to sell it at the current market price, which means it realizes a loss. According to the Federal Deposit Insurance Corporation's most recent quarterly data, U.S. banks are sitting on approximately $6.8 trillion in securities, and a significant portion of those securities are underwater due to the interest rate increases that occurred from 2022 through 2025. This is not a secret. It's disclosed in regulatory filings. But it's not a problem until it becomes a problem, and it becomes a problem when banks need liquidity fast. Now, let's connect the dots. On February 5th, 2026, repo rates spiked to 9.2%. 14 institutions accessed the Federal Reserve's emergency standing repo facility. Why? There are three possible explanations, and all three point to the same systemic risk. Explanation 1. A major institution or multiple institutions are facing margin calls or redemptions that require immediate liquidity, and they can't sell their treasury or mortgage-backed security holdings without taking massive losses. So instead, they're borrowing in the repo market at 9.2%, which is an absurdly high rate because the alternative, selling their bond portfolio at a loss, is even worse. Explanation 2. Counterparties in the repo market are pulling back because they're worried about the creditworthiness of the institutions borrowing from them. Even though repo loans are collateralized by treasuries, if the borrower defaults, the lender has to sell the collateral in a falling market, which could result in a loss. So lenders are demanding 9.2% interest rates to compensate for that risk, or they're refusing to lend at all. Explanation 3. There's a shortage of cash in the system overall. The Federal Reserve has been running quantitative tightening since 2022, shrinking its balance sheet and pulling liquidity out of the financial system. At the same time, the U.S. Treasury has been issuing massive amounts of new debt to fund federal deficits over $2 trillion annually, which absorbs cash from the financial system. If the supply of cash is shrinking and the demand for cash is rising, repo rates spike. All three explanations point to the same conclusion. The financial system is under liquidity stress, and that stress is accelerating. Now, let's talk about the feedback loop, because this is where a liquidity problem becomes a liquidity crisis. When repo rates spike, when banks can't access cheap overnight funding, they pull back on lending. They tighten credit standards. They reduce lines of credit to businesses and consumers. Credit card limits get cut. Auto loans get harder to obtain. Commercial real estate lending freezes. This is how a liquidity crisis in the repo market translates into a credit crunch in the real economy. We're already seeing the early signs. According to the Federal Reserve's H8 data, commercial and industrial loan growth at U.S. banks has slowed to near zero on a year-over-year basis. Credit card charge-off rates are rising. Auto loan delinquencies are rising. Commercial real estate lending is effectively frozen. Now, layer on top of this the fact that the U.S. Treasury is still issuing over $2 trillion in new debt annually. That debt has to be absorbed by the market, and if the market is facing a liquidity crunch, yields have to rise to attract buyers. But rising yields make the unrealized losses on bank balance sheets even worse, which creates more liquidity stress, which forces more repo borrowing, which spikes repo rates even higher. This is a feedback loop, and once it starts, it is very, very difficult to stop without massive central bank intervention. The question is whether the Federal Reserve will step in with emergency measures in the next 30 days, or whether they're going to let this play out to restore credibility to monetary policy, even if it means letting institutions fail. The forward indicators you need to watch right now. This situation is evolving in real time, and the difference between being positioned correctly and being caught in the liquidation cascade comes down to watching the right indicators with the right frequency. Indicator 1. Federal Reserve Standing Repo Facility Usage. This is reported with a 48-hour delay on the New York Fed's website. If we see usage continue above 10 institutions per day, that tells us the stress is not subsiding, it's intensifying. February 5th saw 14 institutions. If that number climbs to 18, to 20, to 25, we're in the early stages of a full-scale liquidity crisis. Indicator 2. The SOFR spread. SOFR, the Secured Overnight Financing Rate, is the benchmark for repo transactions. If the spread between SOFR and the Federal Reserve's target rate continues to widen, that's a sign the private repo market is under sustained stress, and institutions are being forced into emergency Fed facilities because the private market won't lend to them. Indicator 3. Treasury bill yields at the very short end of the curve, specifically 1-month and 3-month T-bills. If those yields start spiking relative to longer maturities, it's a sign that institutions are desperate for short-term cash and are willing to pay up for it. This is the same pattern we saw in September 2008 when 3-month T-bill yields briefly went to zero because institutions were panic buying them for liquidity. Indicator 4. Credit default swap spreads on major banks. CDS spreads measure the cost of insuring against a bank default. If those spreads start widening significantly on names like JP Morgan, Bank of America, Citigroup, Wells Fargo, it means the market is pricing in higher default risk. And if the market is pricing in higher default risk, that makes the liquidity crisis worse because counterparties pull back even further from lending. These 4 indicators are your early warning dashboard. You check them daily, you track the trends, and when multiple indicators are flashing red simultaneously, you know the cascade is accelerating. The 3 asymmetric plays for a liquidity crisis environment. Now, let's get to positioning, because understanding the problem is only valuable if you know how to position your portfolio to survive and thrive through what's coming. Play 1. Short duration cash equivalents in the safest possible vehicles. I'm talking Treasury bills with maturities under 90 days. Money market funds that invest exclusively in government securities, FDIC-insured bank accounts well below the $250,000 insurance limit, and ideally spread across multiple institutions. Here's why this is asymmetric. In a liquidity crisis, cash is king. When everyone is scrambling for liquidity, when institutions are liquidating assets at fire sale prices to meet obligations, the investors who hold cash can step in and buy those assets at 30 cents, 40 cents, 50 cents on the dollar. This is how the smart money made fortunes in 2008 and 2009. Paulson, Ackman, Buffett, they held cash and liquidity through the crisis and deployed it when assets were being liquidated. The key is to avoid duration risk. Do not be in long-term bonds right now. Do not be in bond funds with average maturities over 1 year. If Treasury yields continue to rise, those will get crushed. Stay short, stay liquid, stay safe. Play 2. Physical gold and silver as a zero counterparty risk hedge. In a liquidity crisis, the weakest link is always counterparty risk. Your bank deposit is a liability on the bank's balance sheet. Your bond is a promise from the issuer. Your brokerage account is a claim on securities held by a custodian. All of these have counterparty risk. If the institution fails, you're an unsecured creditor standing in line with everyone else. Physical precious metals have zero counterparty risk. When you hold physical gold or silver, you own final settlement. There's no intermediary. There's no institution that can freeze your account or fail and take your assets with it. Historically, gold performs extremely well during liquidity crises. In September 2008, after Lehman collapsed, gold fell initially as institutions liquidated everything to raise cash. But within 3 months, it was making new highs as investors fled into safe haven assets. In March 2020, the same pattern played out. Gold dipped briefly during the liquidity scramble, then rallied over 40% in the following 12 months. The move here is to allocate a meaningful portion of your portfolio, at minimum 10% to 15%, into physical gold and silver that you hold outside the banking system. Not ETFs, not futures, not unallocated accounts where you're just a creditor of the institution holding the metal. Physical metal in your possession or in fully allocated segregated storage where you own specific bars with specific serial numbers. Play 3. Distressed financial sector equities and credit for those with the risk tolerance and timing discipline. When a liquidity crisis hits, financial stocks get obliterated. Banks, broker-dealers, asset managers, insurance companies, they all sell off indiscriminately as the market prices in contagion risk. But not all financial institutions are created equal. Some have fortress balance sheets, low leverage, strong liquidity positions, Tier 1 capital ratios well above regulatory minimums. These institutions will survive the crisis, and during the panic, they will trade at Depression-era valuations that assume bankruptcy, when the reality is they will not only survive but thrive once the liquidity crisis passes and weaker competitors have been wiped out. This is the exact playbook Warren Buffett used in 2008 and 2009. He bought Goldman Sachs preferred shares at a 10% dividend yield. He bought Bank of America preferred shares at distressed prices. Those positions made him billions because he had the liquidity to deploy when everyone else was liquidating, and he had the discipline to wait for maximum panic before stepping in. The asymmetry is that you're buying high-quality institutions at prices that assume bankruptcy when they're actually going to survive. But the key is timing. Don't try to catch a falling knife. Don't try to buy the dip after the first 10% decline. Wait for the panic. Wait until repo rates have spiked even further. Wait until we see forced liquidations in the market. Wait until the Federal Reserve steps in with emergency measures. Then you deploy capital into the highest quality names at the lowest prices. The critical question the market is debating right now. Here's the question that every institutional analyst, every macro trader, every informed investor is debating right now. Will the Federal Reserve step in with emergency liquidity measures in the next 30 days? Or are they going to let this play out, even if it means breaking something in the financial system to restore credibility to monetary policy? This is not an academic question. This is the decision that will determine whether we see a contained liquidity event or a full-scale financial crisis. On one side of the debate are analysts who believe the Fed will pivot at the first sign of real systemic stress. They point to March 2020, when the Fed deployed over $1 trillion in emergency liquidity within days. They point to March 2023, when the Fed created the Bank Term Funding Program within 48 hours to backstop regional banks after Silicon Valley Bank collapsed. They argue the Fed has proven it will do whatever it takes to prevent systemic collapse, and this time will be no different. On the other side are analysts who believe the Fed has learned from the mistakes of 2008 and 2020, and they're willing to let institutions fail if it means restoring discipline to the financial system. They argue that moral hazard has reached catastrophic levels, that every crisis in the last 15 years has been met with bailouts and liquidity injections, and that the only way to break the cycle is to let the market clear, even if that means pain. I don't know which side is right. What I do know is that your portfolio positioning in the next 30 days needs to account for both scenarios. If the Fed steps in with emergency liquidity, cash and gold preserve purchasing power while everything else rallies. If the Fed doesn't step in, cash and gold become the only assets that hold value while everything else liquidates. Either way, the move is the same. Liquidity, safe haven assets, and patience to deploy capital at maximum panic. What comes next? The repo market seized on February 5th. 14 institutions accessed emergency Fed facilities in a single day. Repo rates spiked 104% in 3 hours. The $6.8 trillion unrealized loss problem on bank balance sheets is creating a feedback loop where rising yields make liquidity stress worse, which forces more repo borrowing, which spikes rates higher. This is not a prediction. This is documented institutional behavior, and the pattern matches every major liquidity crisis in modern financial history: 1931, 2008, 2023. The structure is the same. The outcome is predictable. Your portfolio positioning in the next 30 days will determine whether you come out of this ahead or whether you're part of the collateral damage. Cash equivalents under 90 days maturity, physical gold and silver outside the banking system, and dry powder to deploy into distressed financial sector equities when we see maximum panic. This is not about fear. This is about preparation, pattern recognition, and understanding that liquidity crises move faster than solvency crises. The institutions already know. The trading desks already know. The question is whether you're positioned correctly for what comes next. If this analysis gave you a framework that you're not seeing anywhere else, if you understand that the February 5th repo spike is not being covered by mainstream financial media because it's too technical and too scary, then I need you to do 2 things. First, subscribe and turn on notifications because I'm tracking this repo market situation daily as new data is published. This is not a one-time event. This is a process, and you need to be plugged into the data as it evolves. Second, share this with anyone you know who has significant assets in the financial system, who's managing a portfolio, or who simply cares about understanding what's actually happening beneath the surface. The people who will be hurt most by this are the ones who don't have access to institutional-level analysis. The liquidity cascade has started. The only question is whether you're ready.